Good afternoon, everyone. Welcome to our learning series webinar on etmarkets.com. Those of you who trade in stock market or have a keen interest in it often hear about various tools used in TV shows, brokerage reports, and newspaper articles. What are these so-called technical indicators in the stock market, or how do analysts use them to spot future trajectory of a stock or the market? Should you use them at all, or what are the risks involved? To tell you about all these, we have a very popular face with us, Siddarth Bhamre, who is an anchor on ET Now and has been in the stock markets for 14 years. We welcome Siddarth to this webinar. He will first share his views and then which will be followed by a Q&A round. I would request all of you to keep posting your questions in the small chat room on the right-hand side of your screen. Remember, Siddarth is an anchor on ET Now, and going by the rule book, he will not be commenting on any specific stocks. Also, we usually get a lot of questions during the webinar, so I would request you to keep posting your questions faster, which increases the chances of getting them answered. So here we go. Over to you, Siddarth.
Thanks, Saloni. Now, firstly, these won't be my views. Let's see that what I understand from whatever I've observed experts, and I'm not a technical expert, but I've worked with them very closely, and sometimes observation is also a very good teacher. And whatever I've learned from most of the market participants, what works for them, what doesn't work for them, I would try to share over here. Now, first thing that any subject you can't cover in 1 hour. So don't expect that today, after listening to this webinar, you will be technical expert and come 1 p.m. and you have the mantra of making money. It's a learning experience. Every day people learn. Best of technical analysts are still learning how to trade in this market, how to negotiate this market. Now, very basic thing, why technical analysis and why not fundamental analysis, or why some people go for technicals and why some for fundamentals. Now, technical analysis is based on very small theory that history repeats itself. And if I have to elaborate that fact, your behavior in different circumstances is different, and in same circumstances, you more or less react in same way. So technical analysis is more about psychology rather than any science. Just that psychology we try to measure in a pictorial form, different pictorial form. I'll come to that, how different charts are made. But one thing you need to understand if you want to be successful in technical analysis is don't blindly do something that the chart of IDVI is same as chart of Reliance. It doesn't work that way. I've seen most part of my life that moment you ask any technical analyst what's your view on XYZ stock, and even if he is not tracking that stock, he just sees the chart and try to give some interpretation of that chart. I think that's not a correct way to approach. Just like you and I, we are two different individuals. Similarly, stocks are also different. People involved in those stocks are different, and hence for a similar kind of news or trigger, different stocks react in different fashion. So just like you understand humans, you need to understand stocks also. It's more of a psychology, it's more of a human behavior which stocks also depict. And we try to capture that in form of prices, high, low, open, close, and we try to read it. Just a minute more on this human psychology. If it depends on a lot of things, it depends on your temperament, time horizon, financial health, knowledge. So if your temperament is more than mine, I might react very fast compared to you. You might just give it some time to sink in the information, take a matured call. But if my knowledge is not great, or if my temperament is not good, I might get tempted to react soon. So different people react in different way. FIs, DIs, HNIs, retail, different institutions, these people would react in a different fashion to same news. So just following charts or just following some information blindly is not a correct way. If you want to do a successful understanding of technical analysis, select few stocks, and I would say 40 to 50 stocks is good enough, and just track them. How to track them, that we'll discuss. Now coming to the how one should do technical analysis. There are different form of charts, and this is a bit theoretical, so bear with me, because there are some people who might be very new to technical analysis. If you just connect the closing prices of a stock or an underlying on daily basis, you get a line chart, just like you get a the graph of your heart when you're doing some test. That's nothing but a line chart connected with a different dots. Similarly, a closing price connected, or a 15 minutes price connected, or a 1 hour price connected, or a monthly price point connected, that line which you get is called line chart. Then there are bar charts, and there is candlestick charts, and there is something called pointer and figure charts. I won't get into basic, because this you can read from any good website, and you can understand the definition of it. The idea of this webinar is to understand whether you are on a right track when it comes to your approach towards technical analysis. So apart from number of charts, we also need to dwell into which are the good charts which you should refer to. Whether you should refer line chart, whether it's candlestick chart or bar chart. Now, my understanding and the experience which I have taken from others is that if you really want to understand in detail and different patterns, then it is candlesticks chart, and which is very famous, and I'm sure all of you must have heard about this. And we won't get into detail of what are the different candlestick pattern. It's very easy. Just pick up, just Google, and you will read that what are the bullish, what are the bearish, what are the sideways patterns over there. Then sometimes there are different price patterns, and I'll come to it. What are price patterns? And if you are not very clearly seeing them on candlestick charts, then line charts helps to reduce the noise from the chart, and then you can clearly see the pattern. And generally patterns like head and shoulder pattern, if there is a breakout from any zone, those are clearly visible if you see in on line chart. So there is no hard and fast rule that you have to use only one type of chart. The mistake which people do is, okay, I will just see candlestick chart, I won't see line chart. You have to keep seeing. You never know. Now basically most of the people, and for right reason, use candlestick charts, but you should keep toggling. There is not much of difference. Any software which you're using to check, or even on websites, there are a lot of places where you can do technical analysis of your own. There's just a press of a button and it moves from candlestick to line chart or any other form. So keep toggling. Even if you're sure about your view that, oh, this is a breakout or this is a breakdown, try to see the other chart. Maybe you will find something else. Now, trends. There are only three type of trends. One is uptrend, downtrend, and sideways. There's nothing else. I hear a lot of time people say, if it goes above this level, then I will give a buy. If it goes below this level, then I will give sell call. Well, those conditional things sometimes work, sometimes don't. Either stock is consolidating, or it is up or in a downtrend. There's nothing else. So how do you measure these trends, or how do you gauge these trends? There are different parameters, and we'll touch upon it. Very few parameters. One is moving averages, and one is RSI. I won't cover much on other aspects, but we can have questions on those things. And why I'm not covering much, because it's not easy or it's not possible that within 20 minutes I can tell you everything about different parameters. And there are parameters like MACD, Bollinger Bands, and then there are price patterns. Price patterns we'll discuss. There are either reversal price patterns or they are continuation price patterns. When a trend is up and you spot a price pattern, whatever the price pattern may be, and that price pattern is also suggesting that there can be a breakout, I think you should refer more to those patterns. What mistake we try to do is we always try to find out reversal patterns. Now reversal patterns is what that stock is going up and there is some price pattern built, and then you are trying to gauge that now the pattern is changing and there will be a reversal. Most of the time I've seen that the success rates are higher when you try to find out a pattern which is in the direction of the trend. And that's the reason that cliche is there, that trend is your friend in technical analysis, and you name and everyone knows that. So key to success is, don't try to pick out something which is not in the trend. Yes, when the trend change, you might miss out, the first fall or the first rise of the stock. But till the time you don't get the trend, I think spotting reversals, you should leave it to experts, or probably, once you have decent amount of experience in technical analysis, and when you have a decent amount of kitty to play with, then probably, that makes more sense. So charts we have discussed, we have also discussed, trends. There are only three type of trends: consolidating trend. Within a consolidation trend, you will try to find out resistances and support and play within that range. And there are a lot of stocks which don't move much, but you can make decent money once you identify that they are consolidating, and also you identify support and resistances. What is support and resistances? Just a word on that. When a price come and hit a level and keep bouncing from that level becomes support. And same thing goes for the resistance. If price comes and keep hitting that level and comes down, that levels become resistance. So in a range bound market, in a range bound underlying, these kind of trades work well, that you identify where are the supports and go long over there, and where are the resistances and go short over there. Now, before I get to moving average, I also want to touch upon what are the uh, you know lacunas of technical analysis when it comes to patterns. If an underlying is in range, as I mentioned, it is better to take contra calls. That is, at resistance you short, at support you uh, buy. When there is a breakout, people generally get trapped. Technical analysis is very widely used because people feel that if I have identified support and resistance and trend, which is not very difficult to do, mind you, everybody feels yes, they have arrived and now they are going to make money in this market, but it doesn't work that way. It's not that simple. uh, Most of the participants who have power of money also understand that a lot of people follow technical analysis, and a lot of people follow only basics of technicals, and they get trapped. So if there is some stock which is moving in a range of 100 to 110 and I want to sell at 110, what I try to do is, if I am an influential guy, I'll try to take the stock at 112 rupees. Now, what would happen as a basic of technical? I would say that the resistance of 110 is gone and it's a breakout, and 112, so it's a buy. Most of the people, and you would see on TV, right, that many guys end up, giving same buy call. Now everybody's giving buy calls in say ABC stock. Why? Because they are seeing breakout. Now those influential guys, what they try to do is try to create a breakout. Lot of people would generate a buy call, there would be a lot of demand, and then if they have decent quantity, they want to reduce the impact cost, they sell it. I'm not saying don't follow those calls, but you need to know stocks. And hence I say that don't just type in the stock name and see the chart and say, okay, I think it's a breakout and it's a buy. No, that's not a right way of doing things. Identify your favorite 40-50 stocks and do it. Before I go ahead into moving averages, I also want to point out one basic premises of technical analysis, or two basic premises of technical analysis, which is often ignored by market participants. First, that for any stock, if you want to do any sort of technical analysis, it should be a liquid stock. I have seen a lot of people generating calls in illiquid names. Now, because they are not fairly liquid, it is very easy for someone to manipulate the charts. If some stock has, say it's trading at say 1,000 rupees and it has only 1,000 shares traded, you don't need much money to do entire day's volume. So if I want to play with charts, what I'll do is I'll buy a few shares, I'll try to create a breakout, and then a lot of people will come and buy that stock, and that is the time, if I have holding, I'll sell it. You can try to do that in liquid names, but you can't do that in liquid. You can try to do that in illiquid names, but in liquid names, that's not easy. So first and foremost principle which one should follow is don't use technical analysis on illiquid stock. Second, and far most important, is people try to do technical analysis also when stock is under immense news flow. We know stocks like India Bulls, Arcom, stocks which are of late Fortis. They are surrounded by so much of news flows. And basic of technical analysis also says that you should not do technical analysis if there is too much of news flow surrounding a particular underlying, which means that news flow has more power than charts, and it can probably surpass the technical analysis basics. Now I understand this is something different than what most of the people say, that everything is in price discounts everything, but there are certain news which are not in price. So we didn't knew, right, that Fortis is going to announce its results today or not. That was never in the price. It was just that people are anticipating whether results would come or not. So two things: don't do technical analysis on liquid names, and if there is a lot of news flow, avoid those stocks. And again, I'm repeating, make a list of 25 50 stocks which you want to do technical analysis into. You don't have to rush into only because Venki's is going 15-20% up. Not necessary that you have to be in Venki's. Money is not made by getting into a high beta stock. Money is made when you understand stock, and when it is behaving irrationally, that is where you take that opportunity and jump in and make a trade. Coming to moving averages, moving averages is a direction. It tries to give you a direction of a stock and it removes the noise. So if some stock, say it's moving in upward direction, it's going to 105 first day, then 108, then coming back to 104, then 110, 120, and then coming back to 112, and then going to 130. You know that it's moving higher. So what moving averages try to do is smoothen the direction. So you come to know that what is the direction of the stock. There are two type of moving averages. One is simple moving average. That is, you just take the summation of all the closing prices. You can do moving averages of any time horizon. You can do moving averages of probably on hourly basis. You can do on daily basis. You can do probably 200 DMA. That's what most of you might have heard. There are different people who track 89 days, 90 days, 2 months, 1 month. It depends on their time horizon. On a simple moving average, if a stock is moving above its moving averages, that means it is an uptrend. And this is basic. There's no thumb rule that you will always make money by adopting this approach, but you need to know basic before you refine it and move forward. So if a stock is moving higher and it is moving above its moving average, then you generally say that the stock is strong and you should buy that stock. And when it comes to moving average, then that becomes a support. Similarly, if stock is below its moving average, that stock is weak, it is moving down. And when it comes to its moving average, that acts as a resistance, and then you sell that stock. Also, one more important factor, part of moving averages is what is exponential moving average. Simple moving average is just summation of all the data points and dividing it by number of data points. That becomes your point. And EMA, that is exponential moving averages, giving more weightage to the last price movement. Now, what I'm going to say is probably different than what you read in books at this point of time. Generally, people say that for a volatile stock, you should use exponential moving average so you catch the move fast. And if stock is not volatile, then you use simple moving average. My take on that is a bit different, and maybe because my time horizon of viewing things are different. If there is one stock, and say stock which is a volatile stock, there's so many and I can't recall any at this point of time, say DLF is a very volatile stock, or say HDI. Now if I use exponential moving average, and if HDI is moving a lot, many a times exponential moving average, because it reacts to the latest price move more, will give me a wrong signal. My understanding is that if a stock is volatile, we need to smoothen its edges to understand what it is doing. Hence, use simple moving average for volatile stock. And if some stock is not volatile, say case in point NTPC, though these days we do see some volatility over there, but for lack of any other better example, I'm using that. Now NTPC is not a very volatile stock, and it doesn't give you a big move, right? If the stock goes from say whatever it's trading at 140 to say 160, it's a big move for NTPC. So you need to catch that move fast. So if you just rely on a simple moving average, you may not able to catch that move. So you need to see exponential moving average over there. We are discussing moving averages. We'll also now shift to RSI. But mind you, there's no one single parameter which generates a buy or sell call. There are 4 to 5 parameters which works for you. You need to see a combination of all, and then decide whether you need to adopt any trade over there or not. Coming to RSI. Now, what is RSI? RSI is a momentum indicator that which direction markets or underlying is going, and whether whether what is the speed of that, whether it's overbought, whether it's oversold. It's a mathematical calculation. RSI is like 100 minus 100 upon RS, and RS is what is the average gains or average losses you have taken. Now, it's a range with 0 on the lower side and 100 on the higher side. Anything above 70 to 100 is considered as overbought zone, and anything which is below 30 is considered as oversold zone. But mind you, for different stocks, like for stocks like India Bull Real Estate, uh, till the time it doesn't go to 85, 90, I won't consider it as an overbought zone. Till the time it doesn't go to say 15, 20, I won't consider it as oversold zone. But there would be other stock like Reliance that you may never see Reliance going to 15 level or 10 level, or it goes very rarely. So for that, the oversold range would be probably around 20, say 25, 30, 35. So depending upon stock, there is no thumb rule. The textbook gives you only the basic part of it. You have to look beyond textbook to become a better guy when it comes to trading. Now, generally people take 14-day average price to check RSI. You can do 10, you can take 21. There's no thumb rule. But lesser the price you take, lesser number of days you take, lesser the price points you take, higher would be the stock possibility of stock going in overbought or oversold zone. And number of days or number of data points, if you take more, the overbought or oversold zone will reach. I'm going to say it would take more time to reach in overbought or oversold zone. So completely, you have to do experimentation with all these things. There's no thumb rule, or there's no 5 points which I'll give you in today's session and say if you follow these 5 points, then you will make money in this market. Again, I'm repeating, number of stocks should be less. Track only few stocks which you are very aware of. I'm not saying that you should know fundamentals also. If you know, well and good, nothing like it. You can mix things and do things. Liquid stocks, and don't follow stocks which are continuously in some news or other. Technical analysis doesn't work over there. Also, very important point is trends. You cannot catch anything at lowest point and try to sell it at highest point. Even when you get the trade, you don't ride it for longer period of time. So even if you are identifying price patterns and some stock is going up, then it is consolidating, try to identify price patterns which are in direction of the trend. So these are few things. Means I can go on and on. We are already like 20-25 minutes into the webinar. So what we can do now is take some questions, and I'll try to answer to the best of my knowledge. Just a disclaimer: I am not a technical analyst, and not necessary that I would be able to give you a very articulate or very perfect answer for your questions. But I'll try my best to add some value to your queries.
Well, thank you, Siddarth. That was really insightful. So, me being a novice, I will first ask a question from my end. What do these technical charts really suggest? Do we, as traders or investors, have any pattern of a market behavior or in our response to a market situation?
So as I mentioned in the beginning of my talk, that charts are nothing but what is the historical price movement, how these stocks have behaved in past, or how the underlying has behaved in past. You have charts in currencies, commodities, debt, and you have chart patterns in weather also. So what we try to see is the past price movement, and on basis of that we try to predict future price movement. And that's all about technical analysis, that you see past and try to predict future. It works on a basic theory that everything is known to a market. It's an efficient market. So everything what news flow is there is discounted, and hence there's no need of you knowing much of news. And I'm purely talking theory over here, and because this is a very basic question, so it's a theoretical answer to that. So technical analysis is like price knows a technical analysis, someone who knows everything about price and nothing about value. And fundamental is knowing more about value and probably nothing much about what's happening to the price. And that's the basic difference. As an investor or as a trader, technical analysis can be used to time your entry and exit from the market. If you're a trader, you can make your trade on basis of that. But for investors, yeah, it's an important tool. Means you should not discard it. We have seen that fundamentals is a more respected theory than technicals, and that is more because technical is a subjective subject. It's like beauty lies in the eyes of beholder. So a pattern which I see, probably you may not able to see, and it's subjective. That's the reason most of the people don't try to believe in it. But as an investor, for trader, it is very easy to convince that you should adopt technical analysis. But for investor, it can definitely help you for entry and exit points if you have made fundamentally a call that you want to enter into the stock or you want to exit from your holdings.
Well, thank you for that answer. And we will now move on to audience questions as we have a lot of them coming in. The first one is from Mr. Narayan Vedapathak. He says that he finds market technicals rather complicated. So he's asking which is the best option to follow fundamental analysis or technical analysis?
Well, first, Mr. Anand, you need to decide why you are entering this market. Is it like, the thrill of market attracts you and you want to do something on daily basis or probably weekly or monthly basis, or you are here to create wealth? In both the aspects, you can use technical analysis, but if this is not your primary source of income, if you are not full-time employed in markets, then it is better to follow fundamentals and also have some understanding about technical analysis, but you don't have to learn it. If you are here to create a secondary source of income, if you are here to create wealth, then you can just go through some reports which are suggesting, yes, a basic understanding helps to learn and read those reports. But it completely depends on your objective. If your objective is long term, then I think you should go more with fundamentals and just learn technicals for a heck of it. But if you are very active in market, and when I say very active, even if it's like you're buying something and selling in 3 to 6 months, I think you should know technicals.
Well, the next question is from Shrikathan Rajan. He's asking what parameters would you recommend and what kind of time frame to consider for purely intraday trading?
Okay, that's tough question because intraday trading is not everyone's cup of tea, and certainly not mine. So I don't know whether I'm a right person to give you advice or not, but certainly I will tell you my experiences. Firstly, for intraday trading, it is not just technicals, but also something called screen reading, which a lot of people depend on. That is also something which you need to follow. So you probably would have a technical software over here and probably screen, and you should also see where the trades are happening more, where the liquidity is moving, which stocks are making days high. Those things also help. Obviously, some of that is days high and everything is captured in charts. So there are certain things called stochastic and RSI we dwelled into, that would help you in intraday trading. Of course, support, resistance breached, moving averages, I think it's all packed. You don't have any specific one parameter which would say, okay, follow this parameter and you would make a decent intraday money in this market. It's combination of all factors, but what you have to do is you have to tweak it. If you're an intraday trader, there's no point seeing 200 DMA. There's no point seeing 2 months or 1 month DMA. What you have to see, then you have to tweak all your parameters according to intraday. So if you are a guy who's following RSI, there's no point seeing 14 days RSI. Then you have to change the RSIs. You have to change the moving averages according to your time frame.
So the next question comes from Neeraj Kumar. He's asking, what is the best indicator to spot a possible breakout in a stock?
Okay, that's interesting question, Neeraj. Firstly, broadly, the answer remains same, that you have to see everything, but I'll be very specific over here. Suppose some stock is having some resistance. Say that stock has a resistance of 110. It is coming at 110 and pushing it again and again. And then one fine day, you see that it is trading at 112. So most of the people, what you are seeing, I am also seeing that, and I will also say it's a breakout. But the best indicator of a breakout is whether that breakout is happening with volumes. Many a times, and today also see, and very respected names in market, that people are not giving too much of weight to volumes. So if some stock is in a range and if it's moving higher, then certainly it should be backed by a lot of volume. That and volumes come when more and more people believe that this is going to happen. If it happens without volumes, then be wary. I'm not saying that breakout will be wrong. Now this is a common blame which people put on markets. Breakout happens and then stock comes back again into range and they'll say two things: it was a false breakout and follow-up buying didn't come. And I think that's a lame excuse. It's not about false breakout. You didn't read it properly. It is not market's mistake. And follow-up buying, why follow-up buying should come? You should gauge that it would happen. So volume is one thing which I see, that is something which one always has to see. Then RSIs, whether if that breakout is happening after RSI is making new high, that is also one of the parameters you need to see. You also have to check moving averages. So broadly things remain same, but to answer to your question is volumes. Keep eye on volumes.
Well, Priya Prata Mishra has the question: when to use MACD? What are slow stochastics and fast stochastics?
So I'll go to stochastics because I've touched upon that. MACD I won't cover in this session. Stochastic, slow and fast, it completely, as I said, for RSI, there's a time horizon which you can put it. Similarly, for stochastics also, you can put the same time horizon. Also, in RSI and stochastic, especially in stochastic, you have two two bands moving. So the crossover of band is also important. A band which moves slow means I would call it as slow stochastic, and there is something green band which moves faster. That's a fast stochastic for me. Also, depending upon the time horizon, if I'm taking a lesser time horizon, my both bands would move faster from overbought to oversold zone. So these are the things which I know about stochastic. And stochastic is not a very it's not my favorite indicator to see what's happening on charts. It's a raw form of RSI, I feel. And if you really want to follow a momentum indicator, I think RSI is a better indicator than stochastic. Stochastic generally helps people who have a very short-term time horizon, 1 hour, 2 hour, 3 hour. Yes, you can have a dated stochastic also, which would help you in terms of one more confirmatory trace apart from breakout, apart from RSI. And if stochastic is also moving in that direction, then it can be used as confirmatory trace. But I would suggest you to spend more time with RSI than stochastics.
This gentleman has another question. So he's asking what are MACD and Bollinger Bands. I think we've covered MACD already.
No, we haven't covered MACD, but I don't want to cover in this session. Bollinger Bands also, I think talking too much about different topics would just confuse some of the other viewers. Bollinger Bands are just like, again, they are gauged to see whether you are in overbought or also. So these are all oscillators, momentum oscillators, that in which direction stocks are moving and whether you should see whether this is an overbought or also zone. Sometimes people try to use Bollinger Bands to create contra trade, and I'm not a big fan of Bollinger Bands either.
Okay, so Mohan Nayak asks, what are the demerits of using technical charts in trading? Are there any, or
well, there are many. Means I can give you a list of why you should not use technicals despite following them. If you don't know it properly, you should not use it. As I mentioned, it's very easy to learn technical analysis. Just see 2-3 lines. Okay, it's moving up, moving averages up, so let me buy it, and you fall into a trap of it. So demerits is if you're just seeing technical analysis in isolation, there are certain characteristics of stocks which you won't able to capture in stock. I would say charts. So that would lead to you interpreting it wrong. Can get some water. Give me a minute. So that's not because of your question. I think I'm talking a lot. The only demerit which I see is people blindly following technical analysis without knowing how the stock moves. I tell you that okay, this is the chart ABC, and if you're a great technical analyst, what you'll do is you'll just see the chart. This stock has crossed its resistance. I think this is a breakout and it's a buy. I'm not a fan of that kind of technical analysis, and I think that's a biggest demerit. The other demerit is that if you know a business and compared to, and I'm comparing now technicals to fundamentals, you can envisage something which probably charts won't do it. Like there are some stocks which are just going one way, whether up or down. If you know the fundamentals of business, like Arcom, so many people are stuck, and I'm sure many of you who are listening this webinar are also stuck in Arcom. Many a times, technical analysts have generated buy calls in this because it has taken support or it has given some breakout and resistance. But stock over a period of 2 3 years has seriously dented value or a portfolio wealth destruction, I would say. Arcom has done over a longer period of time, which charts were unable to capture in a big way. Yes, I'm sure a lot of you would have generated sell calls also in Arcom, but you are also guilty of generating buy call on Arcom because of charts, whereas fundamentals have never suggested to buy Arcom.
Mr. Dinesh Kandasamy is asking, is it prudent to use technical indicators to trade in the market?
Now, the session is all about that, and yes, of course, you should use it. And if you're a trader, indicators like moving averages, RSIs, different price patterns, which we haven't discussed because because of time constraint, uh, that is something is more important rather than just seeing momentum indicators like MACD or stochastics. I would suggest people to uh, learn price patterns and how those price patterns and volumes can be correlated with each other to generate calls rather than just relying on oscillators. Oscillators are basically for people who are uh, more short term in nature. RSI, as a matter of fact, can be used by positional traders or investors also. Now there are a lot of places where stock goes at new higher levels, but RSI is not making new high. So that is a divergence between RSI and prices. So RSI tells you, okay, despite it is a breakout, don't buy it. That kind of thing is there. Sometimes prices are making new lows, but RSI is making, it's not making new lows, which suggests that okay, maybe it's a breakdown, but I think you should not sell it because RSI is not indicating it. So there are various tools. I just told you something which just came at top of my mind. I also spoke about moving averages, and there are a host of factors. So yes, of course you should. It's very prudent. In fact, without indicators, technical analysis is meaningless.
Um, so Shiva Prakash says that this person is new to technical analysis, and what are the best ways to learn technical analysis?
A clean slate is always a best slate according to me. So you don't know anything, and that will work in your favor. And if you are listening to me at this point of time, don't follow technical analysis blindly. If you get a chart, don't just try to put parameters over there. Select 25 50 stocks depending upon how much time you can devote, and select different kind of stocks. Don't select ICICI Bank and Axis Bank together. Select ICICI Bank, select SBI, select Reliance, select some mid cap stocks, different kind of stocks, stocks with different volatility, stocks with different industry. There's no point selecting all the banking stocks. There's no point selecting all OMCs. So select different kind of stocks and then try to apply your what whatever you're learning uh, into practice. Now, whatever I told you today, Shiva, in terms of moving averages, price patterns, trends, you need to learn it. And I'm sure within 15 20 minutes, whatever I spoke, and if you're new, even if 5% have gone into your head, I think that's a target achieved for us. And it's okay if you don't understand much of things what are spoken on such forums, because you are learning, you are new into the subject. What would help you is learning. There are various sites, and I'm not going to take name of any sites over here, but you need to read a lot and then put everything into practice only on those limited stocks, and track stocks. It is not necessary that you will learn technical analysis only by trading. Track it.
Well, the last of our question, Surya Narayana asks, Pradeep says that I usually follow swing index and draw trend lines, support and resistance lines. I also use Heiken-Ashtree 1 hour candles. Additionally, I use MACD's stochastic momentum index and trade in Nifty futures. So your view on that?
Firstly, I will tell you, if you're using all this, then you know more than me. So you don't need to be part of this webinar. So I don't know what is Henkin and She 1 hour candle which you're using. I've never heard of it. My knowledge on technical is not that great. I think whatever you're using and if it's working, it's fine. Means I usually follow swing index and draw trend lines, support and resistance line. I think the seminar or this webinar was all about that, Surya. Uh, but I would suggest you, maybe you're using Nifty futures only because it's easy to do research over there, or probably the margin requirement in Nifty futures is less compared to stocks. Uh, but every day or regularly predicting trend in Nifty futures may not be so easy. If you have, and I'm not saying increase 25, 50 stocks, track some large cap stocks also and do trading or investment in large cap stock also, or at least study some large cap stocks, and that should help you. Otherwise, if these things are working for you, I think it's great. Moving averages, I can't see whether you're using moving averages or not. And I am also not seeing RSI. So these are two things which are very simple to understand, and you can follow them and see if that makes any changes. Otherwise, there would be something new always.
Well, thank you, Siddarth, for your time, your insight, and your guidance. But because of lack of time, we won't be able to take a lot more questions that are with us from the audience. Siddarth also has a show waiting for him on ET now, and you can catch India's buzzing business news channel for to watch Siddarth and various other anchors live. Well, I would like to thank our esteemed audience and especially those who took an active part in this. You can catch this webinar video live on webinar video on etmarkets.com. We hope to have all of you back for our next webinar. Thank you so much for joining us.
Thank you.